sticking around for part 2, and we're going to pick up exactly where we left off in part 1. Thank you so much.
Relations are starting to blow apart.
It'll be interesting to see. I mean, that would be your sign that things are getting pretty dicey if that's the case. Because
the markets and the VIX should be inversely correlated, not correlated. When they start correlating, it's like, what the heck's going on here?
Yeah, make you start wondering. Yeah, it'll be interesting to see. Again, what this means toward, as I steer this back to gold and silver, I mean, I feel sometimes like I'm just one man on an island. Like I'm in some kind of weird universe where I'm the only person that sees this. And I know I'm not. I mean, you guys are familiar with this too. But as you look at the price of gold, what they call gold, the price that goes across your screen or on your Bloomberg or whatever, that's the price of the COMEX or LBMA digital derivative contract. That's what someone is willing to pay for an exposure to gold. And that is somehow determined to be gold. And people say, well, I can buy or sell at that price. Well, yeah, because everybody recognizes that price, and physical metal is supplied into the market by the bullion banks to manage that price. But it's not a market where anybody's actually exchanging physical metal. And then at the end of the day, it gets back to this idea that there's 100 beneficial owners or more to every single ounce that's out there. And that these derivative futures markets are just a confidence scheme, no, it's gold because it's gold. They tell me it's gold, and so this is gold. I had my ETF, my unallocated account, my, whatever. But when the day comes that, like as you described, Dave, everything kind of starts to crumble and fall apart, and this illusion of normalcy and prosperity is shattered, and people begin to demand gold. And they find that, wait a second, that's my ounce. No, that's my ounce. What are you talking about? That's my ounce. That's when we'll find what the real value of gold is, what it really changes hands at from a dollar standpoint. But for now, it's like we've always said. I mean, if someone's willing to take and exchange 1,200 Federal Reserve notes for an ounce of gold, I think I'd take them up on it.
Yes, without question. It is money. And like you were talking about a minute ago, as far as the Forex market being, 5-6 trillion US dollars, US Federal Reserve notes being traded every single day. And we know that market is rigged. Why wouldn't everything from that point be rigged?
Yeah.
I mean, and they have to keep gold in check in order for that scheme to work. And they have to keep gold in check in order for the Dow Jones scheme to work. They have to keep gold in check to keep all of these other rigged markets in check. And, it all begins and ends with this derivative called gold that has nothing to do with the physical product. And it has nothing to do with the reality of the money that gold is. And the Shanghai Gold Exchange, Craig, how is that the premium, what I call backwardation, because that's what it looks like to me, is how is that going to manifest, in your opinion, into an actual arbitrage, or will it manifest into an arbitrage? And what do you think, or what are you seeing as far as the Shanghai Gold Exchange stepping up and saying, we've had enough?
I've thought a lot about that recently because it's been such a big deal. We saw the premiums and that backwardation you talked about in Shanghai versus London and New York explode after the election.
Yes.
Went from when they first started having a twice daily yuan denominated fix back in April. Those premiums were always about 0.5%, and then exploded, got all the way up to 4 and 4.5%. I think they're now back down on some days closer to 2, even less.
Yes.
And there's these thoughts that, there should be this big arbitrage, that you would buy gold in London at the lower price and then sell it in Shanghai at the higher price. and capture the difference. That an efficient market would work that way. Where's the point at which that becomes profitable? Because London gold is a different purity, and the bars are a much different size than what they accept as the standard in Shanghai. And there's a lot of different things going on there as to calculate how wide of a spread that has to be for that arbitrage to kick in. I don't know, and I don't even know if there will be. It's an easy way for theoretically for China to accumulate gold by offering that arbitrage opportunity, right?
Right.
I mean, hey, bring it on over here. We'll pay you an extra $50 an ounce, and you can accumulate. I mean, that works in basically everything, right?
Yes.
I don't know though. I have thought for a long time, going back to, do you remember the Pan Asia Gold Exchange?
Yes.
And that was kind of a non-starter back in 2010 or 11. And then they had another iteration of that. I can't remember what it was going to be called. And then finally we got this Shanghai Gold Exchange a couple of years ago, and then they started their fix. I see the Shanghai Gold Exchange more as a piece of the foundation, a cog in the process, whatever the right metaphor is. And that in a bigger picture, the Chinese and the other dollar creditor nations, which many people call emerging markets, I think they were all caught flat-footed in 2008, kind of playing ball within this dollar-based, debt-based system, thinking, we'll kind of play along, and we'll take our dollar reserves and we'll put them in your treasuries, and you can pay us interest and everything. And then all of a sudden, that system basically died. And it's been kept alive on the life support of free money, QE, low interest rates, all that kind of stuff since. And I think the Chinese and these other, again, emerging markets, if you will, have used the intervening time to lay the foundation, build the framework of what will be an alternative system. Well, maybe, whether it replaces the current system is kind of a theoretical discussion, maybe for another time, but I think eventually they offer an alternative. It gets back to what did Secretary Connolly call the reserve currency status of the U.S. being our exorbitant privilege, right?
Yep.
Well, why the hell else why wouldn't Chinese want that exorbitant privilege in the 21st century? I mean, it allowed us in the 20th century to, go off the gold standard, print all this money, ruin everybody's standard of living here in the U.S., but at least export all the inflation around the world rather than, the dollar's our currency, but it's your problem, was another famous thing that he said. Well, that's nice. And we've, I guess, in a sense, had enjoyed that. It's gotten pretty rough here the last decade. Well, I started thinking years ago, why wouldn't the Chinese want that privilege in the 21st century as a way to mollify their masses? The politicians and the bankers used all that money over the last 4 centuries, to all these social programs and wars and everything else. Why wouldn't the Chinese or other countries want that in the 21st century? And so after being caught flat-footed and staring the demise, and oh my gosh, now what are we going to do? In 2008, I think they've laid the framework, the foundation for a new system over the last few years with all these cross-currency swaps they've set up, bypassing the dollar, and I think the Shanghai Gold Exchange is a part of that, in that they recognize that if they're going to have the power, then pricing gold and the ability to price gold is part of that power, expecting a day to come when London and New York's ability, passes away, then the focus will shift to them. So anyway, putting that all back together, I'm not so sure that the daily fixing is as much of a short-term, let's collect gold type of feature for them as much as it is a long-term, here's where we are going, and we're putting this in place now so that it's there for, and building credibility for the future.
Do you think that the SDR plays a role? The Chinese love the SDR. They've been very vocal about that, and being included in the SDR basket of currencies was a big deal for them.
Yeah, it's all part of
getting this MSDR bond issued and getting that whole train moving.
All
that
part
was
of that
a big deal.
It's all part of the same process, Rory. Internationalization of the yuan. That's all part of the same process that's been occurring for the last most importantly, last 8 or 9 years. There's this idea again that Trump is going to be increasing infrastructure spending, which is far from being a done deal. But that he's going to keep spending and ramping up government spending, and we're closing in on $20 trillion, and going to be cutting taxes. And I know all about dynamic analysis versus static analysis, but in the short term, that's going to decrease revenue to the government, which is going to increase the deficit, at least in the short term. All of this borrowing's got to come from some place in a world where the Chinese, either through the process that we've been talking about or the threat of a trade war and tariffs and all that stuff, are clearly liquidating the treasuries, as are the Saudis. Somebody's got to buy our paper. And whether it's going to be some, this kind of covert QE from the Fed, or whether it's finally just helicopter money, in that it's not U.S. helicopter money buying U.S. debt, it's the Japanese and the Europeans that are buying U.S. debt and providing the funds, but somebody's going to have to do it. And how that all connects back into, making the dollar stronger and all this other stuff that is purported to, be in the cards for 2017, I'm just not sure. I'm going to have to wait and see on all that. And in the meantime, keep buying my gold.
Exactly. Buy more gold. Oh, well, Dave, you got anything else? Should we let Mr. Ferguson get back to his day?
Well, let's just circle back really quickly here to the proposition I extended at the start. I think gold's going to perform better in 2017 than 2016. Craig, what do you think about that?
I think we'll know within the next couple of weeks if that's going to be the case. I can't remember if we talked about this on mic or off mic earlier, but as I laid out earlier in the call about how much 2016 or 17 is looking like 2016, there's a mile marker in the road that everybody needs to pay attention to. As gold was rallying back in 9, 10, and 11, and even in 2012, it was riding as support a very key long-term technical indicator that we would call a 100-week, or you could call it a 500-day moving average. And it would come down and brush that, during sell-offs, and then it would bounce and rally. Well, anyway, you can imagine when that was finally broken was in 2013, and then price collapsed and dumped, and we all know the history. Well, things were starting to look up in early 2015. The dollar had rallied sharply in 2014 in kind of a disinflation, deflation bias type trade, and the commodities all got washed out pretty good in 2014. Well, everything picked up early in 2015, January. And price rallied in gold, COMEX digital gold, all the way up to within 30 cents of that 100-week moving average. Didn't get through. It then rolled over, and I think everybody knows what happened the rest of 2015. It wasn't much fun. And then, as I've laid out for you earlier, how much this year is looking like 16. After bottoming in 15, gold rallied in January and blasted through that 100-week moving average in February as the Japanese yen was strengthening, all that stuff we talked about earlier. That set the stage then for a further rally, as we know, all the way up to near 1,400 in July. Okay, coming back to present day, we rallied in January. We got all the way up to that 100-week moving average again. It's currently around $1,200, almost exactly $1,200. So we got through it last week, even on a weekly closing basis. You need to do that a couple weeks in a row to really set the trend. Well, unfortunately, as most folks know, this morning we're back down to 1185, so we're back below it. So I don't know, it's probably too simple of an analysis to say this, but watch that 1200 level. If we roll over from here over the next couple of weeks and start moving back down deeper into the 1100s, I think we're more apt to be staring down the barrel of a year that's more like 2015 than 2016. So anyway, long answer to your question, Dave. I think we'll have the answer. We'll know more sometime after next Friday. We get the FOMC behind us, and we get that employment report behind us, and then let's see where we are. Let's see where the dollar is. Let's see where gold is. Let's see where the dollar yen are, and we can probably make some more concrete, something more substantive assumptions.
Come on, man. This conversation isn't a hedge fund. You're hedging. What are the fundamentals
No, I'm
telling
telling
you? Forget the chart technicals.
The
What are the
fundamentals
fundamentals
don't-
telling you? What's your
Dave,
gut telling you?
Come on, man. Fundamentals don't even matter.
They
don't
do.
matter.
They
No,
do.
they
And
don't.
that's
They
why
don't. No,
they
they don't.
do. And that's why gold and silver have been the best performing assets since 2000. Maybe there's
Since
a few
2000,
oddball.
that's fine. But
There may
I'm
be a
talking
few
about
oddball.
2017.
What that tells you is that we're, long run bull market, fundamentals are driving it, and the manipulation can't keep it down ultimately. So, what about 2017? What's your gut telling you? I know the fundamentals that are driving gold are getting stronger every day.
And that's great. That's fine. And I encourage everybody to still look at it that way. But that's not what the world is, man. I couldn't disagree with you more, my good friend out there in Denver. I don't think the fundamentals mean shit. I mean, we can talk all we want about, Chinese imported 150 tons from Switzerland in December.
Fundamentals. The fundamentals are the reasons why they're importing it. The fundamentals do matter because gold and silver have been the best performing assets for 16 years over that time period. And that tells you the fundamentals matter.
For a fundamental reason. But gold's not down these last couple of days based on fundamentals.
Well, that's your technicals, but over the course of a year, if the charts dominated everything, we'd still be headed lower from the 2011 peak.
It's not technicals either. You're kind of conflating all these things together. It is HFTs.
I'm not conflating them. I've always been a fundamentalist ever since my days at University of Chicago when we would discuss technical versus fundamental. I'm like, yeah, great. Technicals are great in the very short run, but fundamentals rule the long run.
But now we're having a fun discussion. I like this. Okay, so are fundamentals why the stock market's up?
In a way, you can say yes if you consider Fed money printing fundamentals.
Because earnings are surging and all that kind of stuff. See, that's what I mean. So what fundamentals do you want to?
Right. And guess what? We're going to have a very big, nasty convergence down to the fundamentals at some point here.
At some point, yeah. And we are definitely going to be having gold surge to God only knows what price it is based upon the fundamentals at some point.
And I think
I agree.
Happen this year. That's my call.
Dave Kranzler says the big reset's coming in 2017.
No, not so, but it's heading towards in that direction. And I think I said we bottomed on December 15th, 2015, and I'm sticking with that.
Yes, me too. I know it. I would again though. Look, I'm the dude that thought, I just don't see where the world supplies gold at 1,200. And so I don't think there's any way gold can go below 1,200. I remember saying that back in 2012. And look what happened. They raided the GLD and did all these other things and somehow were able to supply gold. The banks were somehow able to supply gold at that price and we went even lower. And I too thought that was as low as we were going to go, lower 1060 or whatever it was 13 months ago. And again, as we spoke earlier in this call, I thought that the day after the Fed rate hike would be another low, and it was. But it can certainly go lower. I mean, if the dollar yen goes to 130, which it might, it might. I mean, who am I to say it won't? I mean, there are a lot of larger forces in play than just, me and my MacBook. If it goes to 130, gold's going to go back down into the close to 1,000. I mean, it just is. It doesn't matter what the supply demand is.
The dollar yen's not going to go to 130. That's my
I hope
call.
not.
The fundamentals won't let it.
And that's at the end of the day, that's what the argument is. Can the dollar rise? Because again, underneath the surface of all of this, and we didn't really, and I guess we're just keep going for a minute. Underneath the surface of all this is, and what caused gold to rally in the first stages of last year and the stock market to go down was a dollar liquidity shortage based on the fact the dollar was so strong after those rate hikes. And the Chinese, with their currency pegged to the dollar, were really, really, really getting squeezed, as they are now. And so it becomes kind of almost a circular, self-fulfilling argument in that if the dollar is going to keep going up, that's going to drag by that peg the yuan up as well. And that's going to put more and more pressure on the Chinese to like a big, massive devaluation of that peg. And everybody, at least everything I've read, says if there's a big, massive devaluation of the yuan, that's going to be really, really bad for the markets. I mean, just like this huge calamity if one day the yuan's devalued by 10 or 15%.
And they might. And here's the thing. The administration has made it clear they want the dollar lower because Trump's hinted at it, and Mnuchin, the Treasury guy, and he's the guy in charge of it. So he's in charge of the working group on financial markets now. So
what I'm saying is,
if you look at a daily of the dollar, if it goes a little bit laterally here for a while, it's going to have a nice head and shoulders formation. The dollar's going lower.
Right. Well, and see, that's just it. But the prevailing thought, what I call the generally accepted narrative that's been shoved down our collective throat since November, is that the dollar's going higher. Well, why is it going higher?
We're not interested in the prevailing thought, Craig. We're interested in your thought.
And that's what I'm saying. And that's what I'm saying.
Get the prevailing. I'm not going to read like 50 different research reports and say, okay, I'll take a conglomeration of this.
That's what I'm saying, Dave. I don't think the prevailing thought, I don't think the world is that linear. You don't just simply say, well, the Fed's going to raise rates, and so the dollar's going to go higher, and then the Fed's going to raise rates more, and the dollar's going to go even higher still. Because there are all these other factors in play, not the least of which what this does to China. And so I think it's a far more complicated picture than what folks are being led to believe for 2017. And so anyway, I don't mean to waffle. I don't mean to sit here and say, I don't know where it's going. But I think we'll have a much better idea of where it's going, given another couple of weeks or so. I still think the dollar does not shoot to the moon, and I don't think that it's economically possible to normalize interest rates and normalize the Fed balance sheet and all that kind of stuff. So I'm inclined to believe that rates actually go lower, not higher. There is no bursting of the bond bubble. There is no dollar spike. But again, who am I to be? Maybe I'm dead wrong. We'll just have to see.
And can Mnuchin, can he strong arm the Fed? Can anybody strong arm the Fed? I mean, they make their own rules. They report.
Here's the thing. The level of the dollar right now is already anticipating, we'll believe the Fed, so we're going to say maybe not 4 rate hikes this year, but maybe a couple. And that's priced in. So when the next meeting comes and goes and they don't raise rates, then you're going to start to see the dollar really go below 100.
No doubt about it. And if that begins to happen, and then that forces the dollar yen back down to 100. I mean, when it was at 100, gold was at 1350. So if that dollar yen goes back from 114 to 100, then gold's going to be back up to 1350, 1400. So it to me, I don't mean to make it sound overly simplistic, but the Fed has promoted a market like this where it's all driven by computers, and it becomes kind of simplistic with all these correlations. And so if you think, and I'm just saying not to this to you, Dave, or you, Rory, I'm just saying this to the listener. If you want to buy the generally accepted narrative that the dollar's going to 10% higher this year as interest rates go up, then you should be planning on lower gold. If you think, though, instead that that's wrong, that that's not going to work out that way, that the Fed has been telling us that for years, and once again, they're not going to follow through for all of these different reasons that we've discussed, I think gold's going to go higher. And in the long run, it's going a lot higher because there's a lot less gold out there. Gold's priced as if it's abundant. Silver's a price as if it's abundant. But what's abundant is the derivative, not the metal itself. And when the market will fix that one day, and price will be different.
Totally agree. Totally agree to agree.
We'll see. Anyway, that's where I stand on today, January 25th, or whatever it is, 26th.
Well, we've been speaking with Mr. Craig Hemke from TF Metals Report. And Craig, why don't you tell them how they can get involved with what you've got going on over there?
Well, I'd be happy to. The site is tfmetalsreport.com, TomFrankMetalsReport.com. And it's a great community. I provide analysis on a daily basis and under a little bit of a paywall at $12 a month. But the site itself is worth far more than that, just in the people that populate the community. It's a bunch of like-minded folks. We all pretty much see the world for what it is, and we're all planning for what we call the end of the great Keynesian experiment, where this debt-fueled financial system finally kind of collapses on itself. And so I encourage everybody to check it out. I think you'll enjoy the site and the people there. Again, tfmetalsreport.com.
It's a great site. Highly recommend it.
Yeah, I'd just like to throw in there that the community that's a member of TF Metals Report, most of them are very intelligent, and every time I've been on there, they ask great questions. So I don't think you'll find a lot of the trolls of the world trolling around Craig's site.
Very few.
I got to tell you, that's about the best part of that $12 a month too, boy. The trolls, they're all out there. Everybody knows who and where you'll find them. You'd think I guess 40 cents a day is more than they're willing to pay to be a troll, though. So that's great. It keeps them away.
You just go to Zero Hedge if you need to see what the dark side of the troll world looks like. Just go to the comment section.
That's right.
Well, Craig, we certainly appreciate all your time, and we'll pick this up in the not too distant future.
All right, guys, keep the faith.
Thanks, Craig.